Let's look at the audit procedures. Audit procedures, it's like the steps that are taken by auditors in order for them to get information, the information that is needed. Yeah, all the actions that are taken by the auditors. So it's what we are going to look at in this video, the audit procedures. Still continuing with topic 3, auditing. So let's first list them before we explain them. So the first one is inspection of records and physical assets. We have observation, inquiry, reperformance, external confirmation, recalculation, and then analytical procedures. So those are the audit procedures that we are going to be looking at in this video. They are 7. So we shall start with the first audit procedure, which is inspection of records and physical assets. So inspection, it is the examination of the entity's records or documents, whether internal or external, in paper form, electronic form, or any other media, or physical examination of tangible assets. So here the auditor examines the records within the organization or outside the organization, or they examine the tangible assets in the organization. That's what we call inspection. Inspection is like examining. So they inspect the records and then the physical assets. So an example of inspection of records can be inspection of business plans, accounting manuals, organizational charts, major contracts like loan agreements. Yeah, to see maybe whether they really got the loan, when are they supposed to pay it, and all that. Then another example of inspection, the auditor reads internal reports and minutes. It also reads the internal audit reports and then the minutes of directors' meetings, reads the trade journals, reads the reports from consultants and regulatory authorities, and also accesses the internet of the entity. Another example of inspection can be inspecting sales invoices and then delivery notes to confirm the occurrence of sales transactions, because employees are capable of recording sales that didn't occur. So you look at the sales invoices and then the delivery notes to see if they match. So inspection of records provides evidence that is readily available and widely used at a relatively low cost. Because in case you decide to inspect the sales invoices that are already in the organization, you do not have to incur maybe transport costs or telephone costs. So it provides information that is readily available and at a low or no cost. Then the reliability of evidence from inspection of records depends on the effectiveness of the internal control and whether they are from internal or external sources. So the reliability of inspection depends on the effectiveness of internal control, like the processes that were designed by the organization to make sure that they achieve their objectives. So if the internal controls are effective, then inspection of records and physical assets will be more reliable. So another audit procedure we have is observation. Observation involves watching procedures or processes being performed by others, like you watch things with your naked eyes. Like you see how sales are made, how purchases are made, how employees work on clients, things like that, how inventory is counted. That is observation. You watch things with your own eyes. So an example of observation, an auditor observes whether the entity's personnel follow instructions when counting inventory or when they're paying cash wages to employees, things like that. So they watch with their own eyes. Then the reliability of evidence is limited to the point in time at which observation takes place, and by the fact that the presence of an auditor may influence the way the procedures are carried out. So observation is not a reliable procedure, because when you know that someone is watching you, you will try your best to do what is right. So when employees get to know that the auditor is watching them, when they are counting inventory, they will of course follow all the required procedures compared to when the auditor is not around. So the next audit procedure we have is inquiry. Inquiry is something like asking. So inquiry, it's about obtaining information from knowledgeable persons within or outside the entity. So here, the auditor requests for information from people within the organization or outside the organization. An example can be inquiring from the accounts department staff, and this is the main source of planning information, like the information that is used during the planning stage is gotten from the accounts department. Another example of inquiry can be inquiring from management. You inquire about the environment for preparation of financial statements, the incentive plans. You inquire about fraud or suspected fraud, unusual events, major business risks, and all that. Then you can inquire from internal auditors. You inquire about the design and effectiveness of internal control and their response to their audit findings. You can also inquire from lawyers of the entity in case there is any court cases against the entity. You can inquire about compliance with laws and regulations from lawyers. Then you can also inquire from marketing or sales personnel about the marketing strategies and then the sales trend. So you can inquire from anyone, either within or outside the organization. So inquiry should be used with other procedures because the entity staff may give you biased information. Yeah, they may give you information that favors them. So inquiry should be used with other procedures like inspection, like observation. For example, to test the operating effectiveness of the cash receipts, the auditor makes inquiries of the entity personnel and supplements this by observing the procedures of how cash is received, and then inspects the documentation about the operation of that internal control. So inquiry cannot be used alone because you may get wrong information. So another audit procedure is reperformance. Reperformance, it's like doing something again, something that was already done. So this involves the auditor independently carrying out procedures or controls which were performed by the client before as part of the entity's internal control to check their effectiveness. Like when something was already done by the employees in the organization, but then the auditor does it again to check whether what was done is correct or accurate. So, for example, the auditor reperforms the year-end bank reconciliation to ensure that it was done accurately, or recounts inventory to check the accuracy of the account procedures by the entity. That's what we call reperformance. So this one, it's done for accuracy. And reperformance is only limited to the controls in the system. Another audit procedure we have is external confirmation. So in simple terms, external confirmation, like you get information but from parties outside the organization. So external confirmation is a process of obtaining direct written audit evidence in paper form. electronic form, or by any other medium directly from an external third party in response to the auditor's response. So here the auditor gets information from parties outside the organization. For example, the auditor confirms the existence or occurrence of receivables balances by writing to customers. Like in case the business has receivables is like the people the business is demanding. So the auditor calls those people or sends emails to those people to see whether they exist, those receivables exist. Or in case the business has payables, the auditor sends emails to those people to see if they really exist. That is external confirmation. Or in case a business got a loan, the auditor calls the loan giver to see if they really gave the organization a loan and how much and when are they supposed to pay. Things like that. So that is external confirmation. So external confirmation may provide highly reliable evidence as it is from independent sources, like sources that are independent from the client, because you're contacting other people. Yeah, they are most likely to give you correct information. Another audit procedure is recalculation. Recalculation, you calculate something again that was already calculated. So recalculation is for checking the mathematical accuracy of documents and records. For example, the auditor can recalculate the depreciation expense for the property to see if it was calculated well. Then recalculation gives reliable information on the accuracy of figures, as the evidence is obtained directly by the auditor because you calculate it again on your own to see if it is really accurate or correct. So it gives reliable information. And the last audit procedure is analytical procedures, and this one consists of evaluation of financial information through analysis of the pulsable relationship between financial and non-financial data. Like you compare whether there is a relationship between the non-financial and then the financial data. The non-financial can be a budget. So under analytical procedures, it's where we find the financial ratios. So analytical procedures include investigation of the identified fluctuations or relationships that are inconsistent with other relevant information or that differ from the expected values. So you compare and then investigate the difference. For example, if you compare like what was budgeted and what actually took place. So if there is a difference between what was budgeted and what real took place, so you have to investigate the difference. And you can do that by calculating ratios. Procedures include, since here we are comparing, it includes comparison of first similar information for prior periods. Like you compare the current year and then the previous year. You compare the sales of the current year and then the previous year to see if there is a difference, then that difference should be investigated. You compare the purchases of last year to the purchases of this year, then investigate the difference. Then you compare expenses like that. So there is comparison of information with a prior period. There is also comparison of the anticipated results of the entity from budgets or forecasts. So you compare the budgets, like what was budgeted or what was forecasted, with what real took place. and the difference between the two is investigated. Then you compare the predictions prepared by the auditor, like the auditor will have their own predictions, so you compare with what real happened. And the difference is investigated. Then you can compare industry information, comparison of financial information that are expected to conform to a predicted pattern based on the entity's experience. For example, if the gross profit to sales ratio of the industry is 12%, you investigate whether the entity is matching up to it. Not matching, or if it's not reaching the standard, then you investigate why. If it's exceeding the standard, you also investigate why. So that is all about analytical procedures, and that is all about audit procedures. We shall look at the calculations for financial ratios in the next video. Thanks for watching.